Hi, everyone, and welcome to this week's Buyers Seminar. This week, we are going to talk about mortgages again and how we can potentially combat the rising interest rates. So, if you saw the title, it's how you can use an ARM to get your monthly payment lower, at least for now. And so let me explain that. An ARM is an adjustable rate mortgage. And what this does is it allows your rate to increase after a set period of time. However, it could potentially lower as well. So now let's get into the content and just talk about what is an ARM, how does it work, and what may be some of the benefits and cons to this. So there's generally two types of mortgages you can get. A fixed rate mortgage, which means that your interest rate is the same throughout the full 30 years, or an adjustable rate mortgage. And adjustable rate mortgages allow you to lock in generally under market interest rates for a certain number of time or certain period of time, and then your rate adjusts after that based on what you have. So generally, um, you can have an adjustable rate mortgage that is fixed for the first 5, maybe 7 years, and then every year after that, it adjusts based on the index that it's tied to. Your payment and your rate is then tied to what I mentioned is the index plus the margin that your lender is charging on top of that index, and that becomes your interest rate. So, why would anyone do this? Well, I kind of mentioned before that adjustable rate mortgages can actually have a lower fixed rate for the first fixed term, whether it's the 5, 7 years, whatever your lender offers, and it's generally less than the 30-year fixed rate. It can be up to maybe 1% less than that other rate. So, with people really only staying in their homes maybe 7, 8 years, this could be a great option to have a lower rate during that time and then either refinance if rates lower below what you're going to do, or where your rate is currently at and what you decide to do. Maybe you want to roll equity into the next home, you get out of the adjustable rate mortgage and maybe get into a fixed rate for the next time when the interest rate environment is better for you. Some of the cons, though, this does have risk. And this is kind of what happened during the 2008 crisis as well. With all these adjustable rate mortgages, all the banks, then the interest rate skyrocketed, people couldn't make their payments, and it caused them to foreclose. So there is inherent risk to this. It's not just, oh, you get 1% off of your interest rate. Well, it does adjust and it can go higher. So you need to be very careful and need to look at what maybe your motives are of getting this rate. If you're only looking to stay in a place for maybe 3, 4 years and then sell and move on, or you really, really think interest rates are going down, after this, it may be a good way to get a fixed rate under market interest rate right now for 5, 7 years, and then be able to refinance at that time. Generally, these loan types do have about the same closing costs. You may have more stringent qualifications to be able to get qualified for these loans, but you just need to talk to your lender. This is not a product that fits everyone. Like I said, it does have risk and it's a little harder to budget for. If your monthly payment is moving up and down, your interest rate is moving up and down once you're in that fluctuation period, then it can be really hard to budget. So you really want to take a look at it, talk with your lender if you have any questions. It is an option, though, to get into a home today for a lower interest rate and maybe combat today's high interest rate environment. If you have any questions, feel free to reach out to us. You can reach out to me, or I can get you in contact with one of our preferred lenders, or call your lender if you already have one. So thank you so much. Have a great day, and let me know if you have any